the impact of negative rates does depend upon the structure, particularly the structure of the banking industry. On the whole, retail deposit rates do not go negative. There's pretty good reasons for that. So the higher the amount of retail funding you have in your banking system, the less the impact of the central bank putting its policy rate negative is likely to be. And we do have quite a high proportion of retail deposits in this country. And we have to structurally reinforce that by ring fencing of banks. That's the first point. Second point does depend on, actually I have a third point as well, but the second point is it does depend also on the point in the economic cycle that you use them at. I think we begin to learn that from other countries, but there's not obviously the case studies are quite few and far between. Third point I would emphasize is that I think there's a big piece of what I might call public communication and public expectations, because I think the public would rightly be sort of puzzled and say, well, I thought there was a basic principle in life that when I when I put my money with you, you pay me a return on it, and now you're telling me, it's the other way around, although, as I say, qualification of that. It's the point I just made on retail rates. So, there are real challenges with the policy, but the conclusion we made in August was that, it is something that we should have in the tool bag as an option. Now, a lot of people have asked what to make of the statement we made last week. The statement we made in the minutes last week is, I think, very clear, but let me just explain it a bit. What the MPC said was that we are now moving on to what I might call more technical work, operational work, to say, were we, put that very much in the conditional, to wish to do this, and I'm going to come back to that point in a moment, how well prepared is the financial system in particular and the economy more generally? Now, let me emphasize, there is no surprise in us saying this. We cannot, it would be a tremendous error, it would be a cardinal sin in my view, if we stated that we had a tool in the box, which in practice we didn't actually think operationally could be used, because a lot of that is down to IT systems and so on. Can you actually put a negative number into an IT system in a bank? So it's no surprise that we're going to do this work. It's going to take a little bit of time because it's got quite a lot of technical complexity in it, but it's important. I'm not going to have a situation, and my fellow committee members agree, where we say, yes, we've got the headroom to do this, but in fact we know that we don't know. We don't know whether we can actually do it. That's intolerable. So nobody should read it more than that really into it, that's the next stage of the work. What I would emphasize is that what that means is, yes, it's in the tool bag, but it doesn't imply anything about the probability of us using negative interest rates at the moment. And there's been a lot of speculation that this morning I'm going to make some great revelation on this subject. So I'm afraid I'm not going to say anything more than that, because that's the honest truth. That's where we are.